Hello, everyone. Welcome. We've got a joint presentation today between Rise Capital, where we help investors basically retire early. It's where the passive income adventures really begin, is figuring out how to, first of all, how to pay for it. So we've got my partner, Chris Borden. Say hello. He's the CEO of Rise Capital. Here with us all the way from Hawaii, except he's really in Salt Lake City now. He's crazy. Like, why'd you move to Utah when you lived in Hawaii? But we're glad to have him here. And then we got with us today from Camaplan. This is a self-directed IRA provider so that you can have more control over where you invest your own IRA. And also William Mucker with Camaplan. And basically, we started getting into self-directed IRAs. The first time I remember hearing about it, I was in a real estate like a class, and they were talking about how you could invest through your IRA. And I thought, oh, I have some money in an IRA. And he said, raise your hand if you have a self-directed IRA. And I raised my hand because when I logged into my Fidelity or Schwab or wherever we kept it, I could choose what I could invest it in. It was this mutual fund or that mutual fund. And so I really thought that that meant that I could self-direct my own investments. And I had noticed when I logged into my HSA account that I could also invest that if I had at least $1,500 and I could choose this mutual fund or that mutual fund. So that was what I thought self-directed meant. And it wasn't until later that I realized that there was an entire world out there where I could actually take my retirement funds and move them to a different custodian like Camaplan and be able to then use those in things not mutual fund related, not in public markets, that I could do private equity, and that includes real estate. I had a good friend of mine come and ask me to invest in his tech startup and was explaining to me what a self-directed IRA was. And I was like, oh, yeah, I do not have one of those. And so I immediately got on it, went and converted everything that we had from various places, various jobs that we had them, rolled them all over into self-directed. And now we have a lot more control over where we invest. We have more control over our taxes. We have more control over our growth, just all sorts of things. And so the more you learn about investing and the more comfortable you'll feel with it, the more you're going to want to branch out. So thank you. I appreciate Matt and William for coming on today. We're going to share some information on what these are, how to get them, and how to use them. And we invite your questions and comments if you're watching on LinkedIn or YouTube. We want this to be interactive. Go ahead and just post in the comments, and we'll grab those questions as they come up. And with that, I'm going to just go ahead and turn it over to Matt and William, and then Chris and I will interject occasionally with some questions here and there.
Well, thank you very much, and it's really great to be here. I will say, I think my job is done. There's nothing more to talk about. You kind of made the point really, really clear for us. So thank you very, very much. Yeah, that is that's the thesis right there. So let's get into it. If you go to the next slide. So before we talk about self-direction, we just want to make this disclosure that Camaplan as a IRA administrator. We don't endorse any investments or provide investment advice. And all the information and materials in this presentation are provided for educational purposes only, and all parties are encouraged to consult with their attorneys and accountants and financial advisors, etc. So, Camaplan, we are in the business, and our passion is for administering self-directed accounts, but all investments and investment decisions, those are with the client. So please do your own due diligence. So just a little bit about myself. My name is Matt Moore. I am a business development manager at Camaplan, and also on the call is Will Mucker. He is the superstar from our sales team, and among other things, he's here to keep me honest as I'm talking to you. So, Will, if you have anything to interject or need to slap my wrist a little bit, by all means, feel free to do so. About Camaplan, we just celebrated our 20th birthday in August, actually. It was founded in 2004 by two business partners who are actually brother and sister. And we are in the greater Philadelphia area in Ambler, PA. We've been very, very diligent and purposeful in creating a very client-centered IRA firm. Both the business owners are investors themselves, and this has led to having a foundation of thousands of clients across the country. And the expertise of those founders particularly comes from Carl Fisher, the brother in the group, and he is nationally certified to provide instruction on self-direction. So he's teaching attorneys, financial planners, CPAs, and realtors about self-direction, and is certified to do so. So Emma did a great job already, but I'll just double down on it. But it is worth noting that the anecdote that Emma told, I'm sure a lot of you might be familiar with. We certainly deal with it or discover it with our the clients that we work with. And a self-directed IRA legally is no different than any other IRA that you'd have with one of those larger brokerages that you're familiar with. Self-directed is just effectively it's just an adjective, and it means that you're able to actually direct the capital into a larger variety of assets that you wouldn't necessarily be able to do in a more typical IRA. So there's a typo here on this slide. So the two different categories of pardon me, of IRAs are actually going to be tax deferred on the left and then tax free on the right. So the most well-known examples of either of a tax deferred is a traditional IRA, and then the most well-known example of a tax-free IRA is a Roth IRA. So the best way to think about these is: do you want to tax the seed, or do you want to tax the harvest? So in a Roth IRA, the money is taxed before it goes in, but then all of the gains that you make will not be taxed once you're able to access those. On the tax deferred traditional IRA, for example, the money will go in without any taxes. However, you're going to be taxed when you eventually take a distribution from that account. And then there's some other examples here, and we can talk to you about them as we get later on into the presentation. But just for the sake of the presentation, that's enough on this. So we can go to the next slide, Chris.
Well, let me ask the question. So,
Sure.
like again, trying to make it a little more interactive. But among all of these different IRA plans, self-directed or whatnot, what is the most popular and why?
Sure. Will, I'm going to have you jump in on that question. I have a theory, but you're dealing with these more often day to day, so I'd love to hear your thoughts on this one.
Yeah, absolutely. Happy to answer that. So there's no really one size fits all for these IRA or retirement plans. It really is dependent on who's opening them. I would say most common are the traditional and Roth IRAs. We're a little bit partial to the Roth IRAs just because of what Matt just said. Would you rather pay the taxes on the seed or the harvest? I'd rather have everything tax free because everybody thinks taxes are going up. But if you're self-employed, you might lean towards a solo 401k or one of the business like plans, like the SEP IRA or the Simple IRA, because they have higher contribution limits. But like I said, I'm a little bit partial to the Roth IRAs.
I think, Chris, I was going to say, just in general, to Emma's point, that what she illustrated earlier, the self-directed accounts, they're just not that well known. So when most people start to even get into them, they tend to gravitate towards the traditional or the Roth IRAs. But as individuals are able, like, a little bit more sophisticated in how they're understanding they can use these accounts, they start to understand that, oh, I can open up a self-directed health savings account, which is only going to qualify for, it's going to only be penalty free if I use it for qualifying medical procedures. But if they're being very, very strategic and they anticipate at a point in their life they're going to have higher health expenses, then they're going to be able to really leverage the tax benefits in that kind of account for those increased costs later in life.
I would like to add, there is a plethora of things you can actually purchase under an HSA account. I don't know if you guys noticed it, but Amazon just added some denotations in their products where they actually list this is HSA approved. So you can go, there's a lot. It's not just medical. It's not for just medical expenses as you would normally anticipate it to be. There's actually a lot of stuff that you can buy. But I got another question. Can someone have multiple accounts, self-directed accounts. Let's say like a IRA or a Roth IRA and an HSA.
Yes, absolutely. And a lot of our clients are they dip in multiple areas. There's some parameters on what accounts you have open, but in general, probably the most common multi-account client is going to have a traditional and a Roth.
Hey,
And to add,
just okay, go ahead.
sorry, I just want to add a flavor to the screen. Any investment that you can make out of your traditional IRA, you can make out of your Roth IRA. We have a bunch of clients that open as many accounts as they can to be able to put as much tax advantaged funds into these alternative investments where they're able to secure such a good return where they might not be getting that return elsewhere on like with publicly traded assets.
That's awesome. I was just gonna have to Emma, were you gonna jump in?
Yeah, where does a solo 401k fit into this for self-employed people? Is which column, the tax deferred or the tax-free column?
So that could actually be both. Depending on the plan you open, when you establish the plan, when you're filling out the adoption agreement, you can actually designate that you're going to allow for Roth deferrals into the plan. So if you open up a solo 401k with Cama plan, you can designate to have a tax deferred and a Roth portion. So you can dabble in both ends.
Okay, so that's kind of like when we were working in corporate and we had a employer match for our plan. So we had a Roth 401k. So our contributions went into the Roth, and then their matching contributions went into the regular traditional. So when we rolled those over to self-directed, we actually we had two, right? Because one was a Roth and one was traditional, where the match went and where ours went. And so we were able to roll those both over. Now we have a self-directed Roth and a self-directed traditional, and then we also self-directed our HSA when we left that last company. And the nice thing about it is like once we became full-time real estate investors, we had a couple of years where we posted very low income because we had so much depreciation and other losses because real estate professionals. So then we were able to convert the entire traditional over to a Roth in the year where we didn't make very much money, and we basically didn't have to pay taxes on that either. So just be thinking about ways that you can get creative with this. Our CPA was like, well, you guys didn't make that much money this year, so go ahead and convert your traditional over to a Roth. And so we were able to get a lot more money into our Roth, basically exceeding the maximum contribution by doing that conversion in a low tax year. So we've really utilized a lot of these different plans to supercharge our wealth building.
Nice. So speaking of supercharging your wealth building, there's a whole lot of ways that you can do it in the alternative investment world. And I guess there's good news and bad news. The bad news is that there are some exceptions, and we'll talk about those a little bit later. But the good news is that there are way more opportunities. There's obviously direct real estate, which you kind of just mentioned. There is the notes and mortgages category, so you can lend off of the funds that are in your IRA. There's private placements. So this is real estate syndications. This is kind of like venture capital deals, things like that, all of the above. And then precious metals. Precious metals is probably the most stringent. It's pretty specific on the list of things that you can actually invest in. But still, if you're putting all the pieces of the pie together, there's a whole lot of opportunities that you can participate in through a self-directed IRA.
Are there any things that people should watch out for as they're investing? I mean, outside of the risks of investing, but is there anything that they should be watching out for in any one of these categories that might not necessarily be listed here?
Yep. I think the two that come to mind, and I know Will's going to have more to talk about on that question, but the two that come to mind specifically have to do with first real estate. So, for example, if you own let's say you buy a single family home as an investment property through your IRA, you cannot ever live in that home. So if you're ever thinking like the common example that we like to give is, let's say you buy like a vacation property that you're going to rent out, like a short-term rental situation, and you say, oh, okay, I want to go spend a week in Maui myself. You don't get to stay in that property because it's meant as an investment property. So things like that, and sort of the way that you manage the property. For example, you you have to actually make sure that if you change the floors or something like that and do renovations, you can't do that work yourself. It has to be paid to a contractor or someone like that. So, and that, if you kind of zoom out on that example that I just mentioned, it's sort of making sure that the money that would be paid to that contractor, for example, and that income that that contractor is going to get, that will be taxed. So it's just ensuring that the flow of money and the flow of the taxes still remains intact, and it's not being affected by you doing any kind of work or things like that. I would say the other thing to that comes to mind to your question, Chris, is about UDFI and UBIT, which the explanations for those abbreviations escape me. Will, you'll have to jump in, but those have to do with taxes that occur, tax events that happen when there's any kind of sort of business dealings going on. So if there's sort of business happening on an investment, like if you're if you're invested in a business or something like that, then there can be a tax event based upon the nature of that business. Can you talk a little bit more about that, Will?
Yeah, absolutely. I just want to touch on prohibited transactions that you went over first, and just add a little color to that. They apply to all IRAs, not just self-directed IRAs. The same rules that apply to any other account apply to the accounts here. And we have clients that do these investments every day, and the prohibited transactions never really become too much of a problem. But it's good to be educated about them. And if you ever have a question whether what you're thinking about doing may fall into a prohibited transaction, please feel free to reach out to us. We love talking about this stuff with clients, so don't hesitate to reach out. And then Matt was touching on UDFI and UBIT or UBTI. UDFI is unrelated debt finance income tax, and UBIT is unrelated business income tax. They're very rare. And in the situation where you would have to pay one of those, you would have your tax professional file Form 990T. They'd send it in to us, and then we would send the funds out of the IRA to pay those taxes. But people who have paid those taxes, at least from the ones I've heard from, they're okay with it because they'd be paying taxes outside of the IRA anyway, and they're still using it to earn more than what they're currently earning with their retirement plans and other assets. And then the third thing that I would want to add for people to look out for is a quote from one of our clients, a longtime client, is invest in what you know, understand, and can control versus using hope as your strategy. Right now, most people's retirement funds are tied up into publicly traded assets where you really have no control over what happens. But use what you know currently, what you're doing with your personal funds, whether it's investing into real estate, investing in privately traded companies as an angel investor, or lending money. Use that, put it to use with your self-directed IRA. In a tax advantage plan like the ones that are offered at Camaplan.
Good point. Oh, go ahead, Emma.
I have a question. Because we like to still keep some of our assets in public markets and stock markets. When we first did our rollover, we rolled over the entire thing to self-directed, but then the next time we kept some of it back with our more mainstream so we could just keep it in the stock market. But I think there's just some misunderstandings from people. Should they roll over the entire amount? Can they roll over a partial amount? Which portion should they keep in alternatives? Which should they keep in public markets like the stocks? I know that's up to everybody to make the decision, but what do you usually find works best for people?
Yeah, great question. So we view the self-directed IRAs as more of a tool of diversification. And a lot of people look that way. So we have a lot of clients who will find a property, find a loan, find a private placement or a startup company they want to invest into. They'll put a portion of their funds into it there, leave some in publicly traded stuff that they're used to, that's managed for them. And that's common. And then return the money back from the alternative investments when they're in between deals, and they'll identify a new deal and transfer back and forth. You can transfer back and forth as many times as you like between the plans. It's not a taxable event, nor is it even reportable. There's no restrictions to how many times you can do it. So people always want their money working with them. We don't deal with publicly traded assets. So rather than keep, uninvested cash, not doing anything in the account with us in between deals, moving back and forth, we process everything very quickly, so there's no real lag time with stuff like that.
That's good to know.
Will, to that question, do we see a lot of people who are, completely draining their 401k after they're leaving an investor, or is it they're taking half out? What is sort of the typical composition?
Yeah, great question. So it really depends on their retirement portfolio as it stands. Most people will have a combination of employer plans like 401ks and 403bs from previous employers, and then they'll have their personal stuff like the traditional IRAs and Roth IRAs. If somebody's entire retirement portfolio is in the 401k, most more often than not, they'll transfer it all to us first, and then transfer a portion out to like a Schwab or Fidelity to their publicly traded stuff, dabble into the alternative stuff, and then get into the cycle of transferring back and forth between deals. If they're more diverse in the types of accounts they have, sometimes they'll just transfer one account entirely with us and leave the other accounts outside.
Makes sense. So as I mentioned earlier, there are some prohibited investments, and the list is here in front of you. But the sort of the theme that is associated with all of these, or the common thing with all of these, is that the value of these items, for example, a piece of art or a rug or an antique, are the best examples. They they can be fairly volatile, and that by that I mean I can throw paint on a wall and say this is a masterpiece. I think it's worth $5 million, and Will could say, Matt, that isn't worth $5. So the variance in sort of in value of those things, that's obviously an extreme example, but that's sort of in general, that makes these things something that we can't be custodied in an IRA or a self-directed IRA or 401k. As I mentioned earlier, there are some exceptions with metal, and specifically metal. So on the other slide, gold, silver, those are fine, but most metal and gems are prohibited. And then you can't keep any expensive bottles of wine or anything in your IRA.
I want to, well, Evan, you have something? I know you were just going to say something.
Oh, no, go ahead.
So I wanted to touch back on, you talked a little briefly about, and sort of aligned with I hear it all the time. People think that if they're investing with their IRA, they can't invest in, let's say, their property. And obviously you made the distinction on you cannot live in a property, or you can't necessarily enjoy the benefits of the IRA property. The property, because again, your IRA and you are two separate entities.
Right.
I think that's the biggest thing too. So I kind of want to talk a little bit about that, because I do hear it quite often in the real estate world. Maybe a little bit your perception on it, what you guys hear, and maybe some clarification on what an actual prohibited transaction is. And again, like maybe just articulate that a bit more.
Sure. Go ahead, Will.
Yeah, absolutely. So when the IRS set up these accounts and the rules for these accounts, the big thing were these have to be arm's length transactions strictly to grow your retirement account. You can't be taking the money out to personally benefit, because that would be a distribution, right? So the biggest things is no self-dealing, no sweat equity. And when I say those things in the terms of real estate, self-dealing would be buying and selling from yourself. Because you're probably going to give yourself a better deal than you would give anybody else, of course, if you're trying to make money. And then no sweat equity, because whereas you may not be paying taxes on the income you earn from that property, the IRS wants you to use your IRA to pay somebody who's going to charge a competitive price that's going to have to pay taxes on the income, because they always want their cut. So they don't want you going in there with a paintbrush and painting the walls. You can pick the color of the paint, you just can't paint it yourself. And you can a cool strategy we like to talk about, and we can get into this, is a little bit more more like 102 stuff, but you can partner with yourself. So if you have a property you want to purchase, you don't have all of the funds available in your personal funds, you can use 50% of your IRA and 50% of your personal funds. There'll be two separate investors, because the IRA is a separate entity from yourself, similar to a trust. And as long as the IRA pays 50% of all the expenses and you pay 50% of all the expenses, and 50% of the return go back to each entity, you can partner and use your IRA funds alongside yourself. You still can't receive those benefits from the investment of your IRA. So even if the IRA only owns 1%, doesn't mean you can go in there 99% of the time. You still can't go in there at all.
Yeah. Maybe talk a little bit about real quick about who you can and who you can't. Well, I guess more importantly, who you cannot invest, who your IRA cannot invest with.
Matt, remind me again. Do we have that slide next with the disqualified persons, or am I thinking of another presentation?
Another
I
presentation.
yeah, I don't see it. That's why I'm asking
Okay.
some of these
All right.
questions.
Thank you. So, the disqualified persons, we have a good article on our website about this with a nice chart. So it's mainly anybody of lineal ascent or descent of you, including yourself as the account holder, and any entity that those people own 50% or more of. So we're talking about your parents, your grandparents, your children, and your grandchildren, anybody of lateral ascent or lateral relationships like siblings, aunts, uncles, cousins. They're okay, but it's those people of ascent and descent of you. There are a few other things like fiduciaries of the plan and business partners that are also prohibited from these sort of benefits. But those are the main things. I forget the exact mindset behind it. It's the IRS, and it never really makes sense to me. But I think it's inheritance tax stuff.
Yeah, it's the mindset behind it is normally if you pass away, who is going to get your retirement? It's normally not going to be your sibling. It's normally your wife. Who's the beneficiary typically? It's normally going to be your wife, your kids, or your parents. So that's typically the reason why they're excluded. But again, thank you for adding more content and color to it. I don't want to spend too much time. I just want to get a little bit more education out there.
I do want to give an example here of some joint ventures that we did where my partners wanted to come in with their self-directed IRAs, and I told them, no, you cannot bring any of your self-directed IRA into this project. You are one of the managers. And our CPA said, oh, you can have the IRA be a partner in the business as long as he's either not a manager and owns less than 50% of it, like you said, but that if he was a manager, it was less than was it 12%? I'd have to look it up. But it was really interesting as we were going down this road the first time to find out that the IRA could actually invest in a project where he was a manager as long as it's kept under that threshold. And then he had some restrictions on the things that he was allowed to do in the business. So I was pretty surprised by that. We don't do it very often, but for people who want to look down at that as one of their options, it's a good one to know. We have a lot of real estate investors who put their IRAs with us because they can't invest it in their own real estate projects, but they still want it in real estate. And once they find this out, they may retain a small portion of that to go and do some of their own deals. So I think it's just an important distinction that there are some allowances, like you said, the 50% or the managers with less than 25, 12. Look it up. Just to be aware that that's something to look into and see if it's a good fit for the way that you have yours structured.
Yeah, very good point. I would definitely, I think consulting with the CPA is definitely a good move on all those scenarios.
Mm-hmm.
Very good. So we talked about, who Camaplan is. We discussed what an IRA, a self-directed IRA is, and all the things you can invest in, what you can't invest in. But why would you want to do that? And it might be really clear to this group. Oh, of course, we know what the tax savings are, but I think actually having it illustrated in front of you is a good way to make it even more compelling. So each of the bars represents something different. So taxable would be kind of like just typical W-2 income. Tax deferred is the light green bar. That would be like a traditional IRA, for example, and then the dark green bar, tax-free, would be the Roth IRA. And you can see, over a span of time, how specifically the tax-free IRA really accumulates so much more. And this is a combination of the tax savings and then the compound interest that ultimately comes from those, makes it quite amazing. Just what I think Einstein said, compound interest is like the eighth wonder of the world or something like that. So don't quote me on that, but it's pretty amazing how much larger your nest egg will grow if you're using one of these vehicles. But if you want to go to the next slide, Chris, some of you might say, okay, Matt, I don't have 30 years or 40 years to be doing that. Like what are the savings now? And so even in a shorter term scenario, the tax savings can be pretty compelling. So we have a couple of examples from Rise Capital Investments uh, opportunities that we want to use. So this is from the high yield debt investment fund. And if you see here, this is just interest on that the investor will get. And in the 2-year lockup, there's a 25% advantage of using a tax-free a tax-free Roth IRA versus just using personal funds. And so that's, almost $10,000 that you can go be putting investing in something else. Like Will said, you can be transferring that money to another, like a Fidelity account or something like that, and get it working in another in the markets or something like that. If you go to the next, I'll stop there. Anything to add here, Emma or Chris? These are your deals, so I don't want to run away from it too much.
Yeah, I just want to go back. I just looked it up. It's 10% if you have any management stake. So it's pretty low.
Okay.
All right. So this investment here, I just want to point out on this one because it was if we're doing an equity deal, so we do mostly private debt in our fund. But if we're doing an equity deal, meaning you have profit sharing and profit loss, whereas a debt deal, you just get a stated rate, interest rate. That usually, if a property has depreciation in it, you cannot enjoy that depreciation inside of a retirement account. It's already tax advantaged. You can't also have depreciation stacked on top of that. And I just want to point out that this is a common misconception from people who come to us and they say, hey, I need a project with depreciation because I want to save money on my taxes. And I'm like, but you're investing with your IRA, you're already saving money on your taxes. Right. So that depreciation that you would earn if you were investing in an equity project inside of an IRA can really only be used to offset that UDFI tax that William was talking about earlier. If there's some sort of a tax to the IRA, then the depreciation can offset that. But that's really all you can do with it. And so I think when people realize that that depreciation is not that useful inside of an IRA, they're more likely to open up their mindset about the types of things that they want to invest in and be able to say, oh, like I get charged ordinary income tax on my interest income. But if I do it inside my IRA, I can either have it tax deferred or tax free, depending on which account you own. And the cash flow from the hard money or the private loans is so much more reliable. It's in a safer first lien position. And so over the course of my portfolio, I've actually earned higher return on my lending investments than I have on my equity investments because the equity investments don't always go according to plan. And so just be thinking ahead of that. Like, don't get so attached to the tax savings and depreciation from an equity investment inside your IRA because you can't use it. So just thinking outside the box a little bit that way.
Yeah, just a little bit more clarification. Equity deals, so private equity real estate deals, you're typically going to deal with UDFI. Just depends on, I mean, there is some other calculations in there with depreciation, but you're normally going to have to deal with UDFI on equity deals. So as Emma said, high debt deals, high yield debt deals are a very strategic way to be able to build your wealth and not necessarily have to have the impact of any taxes. So it's definitely a good option. Next, we just have an option of equity. So we want to go ahead and talk about it, Matt?
Yeah, I think it's, you already talked about it, but it is just more of the same. The added variable here is that since this is an equity deal, there's a capital gains tax consideration, 20% tax. So that's going to add on to the advantage of investing in an equity deal through your tax-free Roth IRA. Like you said earlier, both of you were mentioning the depreciation benefits of investing through these deals will not be realized in an IRA. That's absolutely true. So frankly, and our founder would say the same thing, the pure, just interest funds, those are going to be a little bit more of an obvious move strategically using an IRA. Now that said, we've done the math and et cetera, and even with the depreciation, if it's depending on how the deal is set up, and I don't know the total intricacies of this, for example, but if if there's a depreciation benefit that an investor is getting once the project is paid off, if there's also a depreciation recapture. So in that case, the IRA, I think it's 25% is the depreciation recapture, approximately. So in that case, using an IRA to invest even in an equity deal still has some benefit. But I don't want that to detract from what I just said earlier, that the just sort of pure interest debt funds, those just tend to lend themselves more strategically to an IRA. There's no UDFI to worry about, and it's just a lot more straightforward.
Can you just briefly touch on the solo 401k for self-employed people doesn't incur UDFI? I've never really understood why that is. Do you know?
I personally just became aware of that myself in a call that I had last week. Will, can you drop some knowledge?
Yeah, that's a great question. The mindset behind it, I'm not exactly sure, but I do know in order to avoid the UDFI or UBIT out of solo 401k, it has to meet certain requirements.
Mm.
Things like the total purchase price must be the amount, or like any renovations must be included in the amount of the loan, and certain things like that. Some minutia I'm not very familiar with myself, but it does have to meet certain qualifiers to be able to use that 401k UDFI exception.
Okay. Yeah, that's a good one to be aware of. I think that there's some misinformation out there that these solo 401ks um, and the different types of accounts, they all have different rules. And so you just have to be familiar with which account you're opening and the pros and cons of each. So you can pick one that best fits. And like we said, you can have multiple. And so you can have one set up for this type of investment, one set up for that type of investment. So you can really maximize the tax benefits on each type.
Absolutely. So in talking about that, sort of wraps up the portion of talk about the benefits and creating some baseline knowledge in terms of our process of how you'd get started with Camaplan. You would open an account with us first and fund that account. So that's transferring or taking the money from your existing custodian, your existing 401k or IRA, and moving it over to your Camaplan account. The third step is choosing your investment, but most of the time our clients already have their investment picked out. So they're opening their Camaplan account to invest into the deal they've found. Once the money has come over from your existing custodian over to Camaplan, we will facilitate that investment or you will facilitate that investment through a purchase directive. The funds will go over to the investment provider and the money will start working, and you'll see that investment in your Camaplan portal. So it's the longest period that usually it takes is getting the money from the old custodian to Camaplan. In general, we quote about 2 weeks for that. It sort of depends on who your current custodian is. It can be longer than that, but in general, everyone plays nice with each other. It's about 2 weeks. And then our turn time is about 2 days for everything else.
I hear another common misconception, especially with 401k plans. I'll just talk through it. So one of the things I typically hear is that that you can't necessarily roll over an active 401k plan, which I know most of the time is true. However, there are, again, these plans are set up by the businesses themselves. They typically work with a general custodian as well to set up these rules, and they're not all the same. So I would say more times than not, if you're an active employer that has that 401k, I would say ask whoever the fiduciary is, whoever's responsible for the plan administrator, to see if that can be rolled over. A lot of times there's a vesting period. Once you pass the vesting period, you can roll over. But if you're no longer with a company, right, you had an old 401k from a previous company, those can always be rolled over. So just I hear about it. I hear it through conversation quite often. So just wanted to make some clarification on that and see if you guys had anything to add there.
Yeah, so 401ks are a little bit different. Like you said, every plan's a little bit different when they establish the plan. They get to set up certain rules for the plan in specific. More often than not, when you're currently an active participant in the plan, it's most likely stuck there. When you're no longer employed, it's much easier. If you're actively employed, the ways if the plan allows for it, that you can get it out of that plan are either via an in-service rollover, which means you're still actively participating, you're 59 and a half or older, and the plan allows for in-service rollovers. They'll let you roll over all or a portion of that amount into an IRA to do your self-directed investment. The last option, and it's the least likely, is if that plan, when they established it, allows for what we call outsourcing. And I know a lot of the big companies have it built in, like Schwab, their plans allow for it, where you can actually direct a sub account for that plan with another custodian to do alternative investments. And that otherwise, you're kind of stuck there, apart from in service or outsourced.
Yeah, we have a couple of investors who have been with their companies for several decades, and they plan to retire from those companies. So they plan to be with them for several more decades. And they have, at this point, a substantial amount of cash in an active 401k. And some of them haven't been able to move a portion of that over. Oftentimes the answer is no, but I'm surprised how often they say, yeah, we can move a portion. So that would be something you'd probably be working with your Plan custodian to look at your specific plan and find out what those rules are and see. Because at first I thought you couldn't roll over any portion of a 401k, but it turns out that under certain circumstances it might be possible.
Yeah, and a lot of times it's about who you speak to, because I have a scenario where I was helping out this lady with her 401k a few weeks ago. We were on the phone together with Schwab for an hour before we finally got to the person that said, yeah, you can do it.
Yep.
We were getting passed around for quite a bit, but we got it. We got there in the end.
Yeah. I'll share one more example. When we went to go move our money from our traditional custodian over to our self-directed custodian, the customer service person who was helping me with that process advised me against doing it because it was a scam and had never heard of self-directed IRAs before. And then said when we liquidated the funds that would be a taxable event. And I knew that those things were wrong, but just be careful who you're getting advice from, because if they don't know anything about it, they're not going to be able to give good advice. And so he was probably, I don't know, trying to scare me a little bit, but it was just because he didn't understand doesn't mean that that's true. So I like the story where you're getting passed around Schwab again and again and again until you find the right person who has the right expertise.
Yeah, I couldn't agree more. And we always encourage everybody to do their due diligence. Do your due diligence on us. It's definitely not a scam. Like Matt said in the very beginning, we've been doing this for 20 years, but I've heard that story or similar stories to what you've said too many times.
Yeah. We have a question here. It says, do a lot of people forget they can still contribute to their IRA even after they roll over into self-directed? That's a good question. I think, do people tend to stop contributing to rollovers after a while and just stay with the new 401k at the new job?
That's a great question. So, depending on the deal, most people will use funds from an existing plan like an IRA or 401k elsewhere to be able to have that capital available to make the investment, and then make contributions to plans outside of the account to park in mutual funds and publicly traded assets. But like we said earlier, all the same rules apply to these plans that apply to the plans outside of Plan. Contributions, distributions are all the same. We do have a lot of clients that only use self-direction, and yeah, they do annually contribute the maximum contribution that they're able to for their specific accounts. Great question.
I think specifically with the clientele that we're dealing with, just by virtue that they are choosing self-direction, these folks don't forget. Yeah. They're on it, and they're doing everything they can to contribute the max as much as possible.
Yep.
So just a kind of quick summary of what Camaplan does. I think the housekeeping role that we have, top priority, is that a custodian is required, or an IRA administrator is required by the government to open a self-directed IRA. So that's kind of first and foremost our role, and making sure that we keep everything compliant. That's priority one. Um, I mentioned this earlier, but we're a neutral party, so we're not going to provide anything to sell. We Number one, we can't sell or promote anything, but we also feel that's an advantage because we don't have a mutual fund or something like that that we've packaged ourselves and we're going to put on a list of options. So we have nothing shiny to sell you, is what we like to say. Um, we want to make your investment experience, or excuse me, we want to make your ability to invest in alternatives as pain free as possible. And so we're going to use our experience and our founders' experience to make sure that we can that we if it can be, if you can use self-direction for it, we want to be able to be the we want to be able to custody that. We also want to make sure that the process is easy, and you might have to go get passed around on the phone with the other guys. We're gonna have an answer. You're gonna talk to one person, and we're gonna get you an answer as quickly as we can. um, and the last thing you kind of mentioned, we've talked a couple times about bringing in CPAs and getting talking to attorneys, folks like that. We want to be viewed as a resource to our clients. We're not just specifically talking to the name on the account. If your accountant or your attorney has a question, they can reach out to us, and we're happy to work with them to answer all their questions, so that they have peace of mind when they're advising you on how you're going to invest and what you're going to do.
I have a question here for you. Um, Investors have a choice who they use for their third party custodian. So, what really sets a company apart? It's kind of like when you go close a house and you're like, oh, all title companies are the same, right? Until you realize you have a bad experience with bad customer service, or they're doing bad documentation. So, what is it that sets you apart from other options that investors may be able to choose from?
Great question. So it sounds hokey, but it's going to be customer service, and that's that is truly the thing that we offer the most. And um, we don't have large call centers, we don't have complicated phone trees. If you call Camaplan tomorrow, there's a really good chance that you're going to talk to Will. He's going to be the one who's answering your questions. So having just really, really quick, fast service, and whether that's by email or by phone, we want to get you answers to your questions. We want to get you set up and going as quickly as possible. And the way that we do that is by being available to take care of everything. And you're really only going to talk to two people when you're making an investment. You're going to talk to someone on our sales team who's going to walk you through how to get it done. And then once you're actually ready to invest the money after the funds have come in, you might talk to someone on our operations team. And with that, our pricing is very, very competitive. So whereas larger companies, for having that kind of access, they would call that like their premium line, and they would charge additional fees and like that. That's not. Our standard of practice is just premium, I guess. So for that premium service, it's going to be about $300 annually is what it comes down to. So we have arranged some special pricing with Rise Capital Investments, where we're going to reduce the account setup fee from $75 just down to $1. We're going to waive the fees to transfer money, so it leaves about a $300 annual fee plus a one-time $150 fee to actually make the investment. We feel it's pretty competitive with the other pricing that's out there on the market, especially compared to the access that you're going to have to anyone on our team.
And we deal with a lot of custodians because we have different investors bringing in different third-party plans. Customer service is huge. I like you said, it sounded a little bit. It sounds cliched, but when we're on hold and being shuttled around to the company, and then the investors on hold and being shuttled around, and paperwork is coming back because like little teeny tiny punctuation errors, and they have to start over. That kind of friction can really deter people from taking action. And so that customer service from our side, we definitely have some companies that we don't like to work with.
Yeah.
And you make it a lot
Most
easier.
companies won't sit on the phone with you for an hour while they're navigating Schwab to make sure you can self-direct your IRA. So
Good
Yeah,
point.
and
there's
I
that.
think we are talking about investing here. Like there's a risk that's associated with this, so there's already some maybe some
Nerves.
level of anxiety and nerves,
Mhm.
and we don't want to add to that by you having a poor customer by having poor customer service or you having a poor experience. So um, I know it is cliche, but it is something that we value. Our founders each carry portfolios themselves, real estate portfolios, so they're really accustomed to talking to a lot of different people and having lots of different experiences, and so they've had good experiences and less than good ones, and so they know what they want to experience, and they've made sure that's what Camaplan emulates.
Yep, exactly. It's
Um,
very important to get a company that has excellent customer service.
yeah. So what we have here $44 trillion is sitting out there just in the United States in IRA accounts. There's 1.6 trillion, I believe, that's sitting out, not being used for anything. So what we want to do, like, it's super important for us, and that's the reason why we connected with Matt to bring this to you guys, because it's important for you guys to kind of understand and really figure out exactly what you want your life to look like and how quick you want to get there. And the tools here, it just makes it like just profound. So what we are also did was we developed a calculator that kind of reverse engineers it. So we reverse engineered how you look at it to say, okay, what do I want my desired life to look like? Again, Emma did some great aesthetics here. My dream life, like what do I want it to look like and how much is it going to cost me to get there? And then we have a calculator that reverse engineers it for you to see, are you on path to get to where you want to be, and how quick can you get to where you want to be. So free calculator, just use the QR code, get there. And then we have some bunch of other free resources as well. We'll go over exactly what we were talking about today. And then we'll connect you, definitely be able to connect you with Camaplan. And then lastly, we have a few more resources that you guys can go ahead and click on. Tell them, Matt, tell them a little bit about your resources here.
Yep. So a cornerstone of Camaplan, and it goes back to the customer service, but it's a cornerstone of Camaplan's business model is providing education to our clients and to investors about how they can use self-direction. So the top two QR codes are linked to a couple of one is to a video that you can watch. It's like our self-directed 101, just at the basics. It covers a lot of what we talked about today and then some. And then we have our Road to Financial Freedom podcast, where we talk with we go over different topics about investing and things like that. But this is just kind of scratching the surface of all the content that we provide. We have a big backlog of stuff on our YouTube channel. So if you ever have any questions about self-direction and you want to do it on your own time, maybe you can only do it in the midnight hours and you can't call us during regular hours, go to our YouTube channel, go to our website. You can find something there that's going to give you a lot of knowledge.
Well, that's all we have. We don't have any more questions. I really appreciate you guys coming on, instilling a bunch of knowledge and education on us. Really excited to be able to partner with you, gentlemen, and take the investing wealth journey of everyone listening to the next level.
We appreciate the opportunity. I'm going to just say kudos one more time to Emma for just starting the presentation off with exactly the point that we're trying to make, is about what is self-direction, and that it's this amazing tool that not everyone knows is out there. So anyway, thank you very much for the opportunity, and we look forward to working with you.
Thanks for having me.
Thanks, William. Thanks, Matt. Thank you,
Thank
Chris.
you.
Thanks. Yeah, thanks, guys.
Jump on our calendar with us, partnerwithrise.com. You can schedule a call, free 30 minutes, ask us whatever you want, find out about the investments that we have available that you can invest in with cash, but more especially with your IRA, so that you can get those tax benefits on the income gains. Thanks everybody for coming, and we'll see